everyone, I'm back again. So today's topic is about what you should have in your investment portfolio. Okay, so let's go. Okay, so what should be in your financial portfolio? So I'll split it into younger age and older age. Like, of course, definitely the needs and the needs will be different at different age group. Okay, so for when you are young, around the 20s, 30s or 40s, right, this should be the optimal financial portfolio lah. So about 12% in like cash, okay, then 12% also in like housing, and then the rest you should be putting into other kind of like financial products like stocks, crypto, funds, yeah. Okay, so about half of your financial portfolio should be in all these things to grow your money. Okay, then lastly it should be about 20% in insurance. Okay, so for stocks and other financial products, right, so how much the allocation you want to do, it depends on how risky you are lah. Yeah. Okay, then moving to 50s and 60s, usually your house will take up more bigger part of your portfolio. Maybe you want to have like 2 houses because you want it to be more stable growth of like rental income and stuff. So usually the housing portfolio will be about 25%. Okay, then amounts that you still need to hold in cash. Okay, then reduced insurance because now you don't need so much coverage. Okay, and the rest should still be in 25% in like funds, and then because now you're older, right, so you go for lower risk stuff, so probably annuities that pay out like a monthly income lah. Yep. Okay, so why do you need to start planning your financial portfolio early? Is because of the inflation rate in Singapore. But you see the inflation rate, right, is about 3%, but that's not the full picture lah. Because in like the consumer price index, there's many items that are actually very expensive, but they don't, as in they are big ticket items and take up quite a lot of the CPI, but they are actually things that maybe decrease in value over the years lah. So maybe this inflation rate isn't the full picture. Okay, so inflation rate experience is by different people. It depends on what kinds of goods and services that are purchased by each individual lah. Yeah. So some of the inflation figures here you can see for yourself. So housing is about 4%, medical 15%, precisely why you need your medical insurance. Okay, and education is about 13% lah. Yeah. Okay, so as you know, everyone needs to grow their money. Let's explore the ways that you can grow your money. Okay, so before we start on how you grow your money, right, just talk about the real cost of leaving your money inside the bank lah. So imagine you save 1k per month. Every month you just save 1k lah, and then you just leave it in the bank to earn the 0.05% interest. So maybe 0.05% interest cannot even beat the inflation, which is 3 point something lah. So assume that maybe inflation is 3.05. Okay, so your money will be eroding at a rate of 3% lah. So you just key this into the financial calculator and you look at it for like 30 years. So 30 years times 12 months, right, 360 lah. So compound monthly. So even though you save 360k, right, your actual spending power is only 237k. So you're only like left with 2/3 of what you have actually saved lah. So do you want to be saving like that? No, right? This is the real cost of actually leaving your money in bank. It's eroding all the time. And actually when you are young, there's no reason to be leaving it to rot in the bank. That's what my opinion. Okay? So some people think that a way to make earn better interest than the bank's 0.05 is to lend money to a friend and collect interest from them. Because like I heard a story of people lending money to a friend to go and buy their house. So, because the HDB loan is 2.6%, right? So he offered his friend 2%. Okay. So at 2%, right, you are not you need to do this consideration lah, okay? So how much interest is giving you. And unsecured loans, you at least can get 3.5%. So this is definitely an unsecured loan, because it's not say like if he cannot pay you, then you can go and claim his house or anything, right? He cannot pay you, you get nothing back. Yeah. So if like anything happens to your friend, will the family still continue to repay the loan to you? If no, then what are you going to do? There's nothing you can do. Okay, so whatever you lend to your friend, you need to treat it as like money loss, possibility of money loss. Yeah. So another thing to consider is this guy like fully insured, and who is this beneficiary of his insurance? So if say like he passed away and the beneficiary of the insurance is the wife, okay, so the wife take the money. Will the wife return you the money? If the wife won't return you the money, then your money is also gone lah. Yeah, so these are the considerations you need to have before you think of these kinds of way of making money lah. Because it doesn't really, in my opinion, it's not a wise way to be making money. Firstly, the interest rate they giving you is too low, and you might not even get your money back. So you might not even earn at all. Yeah. Okay, so another option is going for endowment plans or bonds. So usually endowment plans or bonds, in the COVID times, it's actually below, it's not even 3 to 4%, it's maybe 1 to 2% for bonds. Yeah, so this might not be enough to beat inflation lah. Yeah, but still, it's a way of growing your money safer than lending money to a friend. So I guess it's a point of consideration for the older people, like when you reach like 50s, 60s, you need the guarantees, right? So this will be the way to go lah. Yeah. Okay. So optimally, for people that are younger, you should be going for stocks, funds, crypto, commodities, options, or REITs lah. Because all these can earn you more than the inflation rate. Okay. So can possibly earn more than 5% per annum to beat inflation. It's a higher risk, but if you want it to be like the risk to be diversified, then you can just go into funds. Don't need to go into all these individual stocks or crypto lah. Yeah. So also there's crypto funds also, so you go into funds instead. So you diversify your risk. But once you go into crypto, it's also high risk area lah. So there's only so much risk you can diversify. Yeah. Okay, so it's a fact that 90% of people, retail investors, lose money in the stock market. So most people think that they fall into the other 10%, but they often turn out to be the 90%. So if you don't believe, you can go and Google. Yeah. So the reasons cited as to why people always lose money on the stock market, right? It's because they do this. So they invest based on a tip instead of doing proper research. They are greedy and want to make quick money. So usually if you have a portfolio of stocks, right, are you those kind who like to realize your gains and then hold on to your losses? Yeah, so if you are doing that, it's like holding on to the bad investments and selling the good ones. Because the good ones are making money, then you sell them, and because you want to realize your gains, then you continue to hold on to the bad investments that you are losing on. Yeah, so these are the ways that people lose money. So another one, lack of patience. It's same lah. It's similar to want to make quick money. Yeah. Then a complicated portfolio. How often have you seen people with like 100 stocks or whatever stocks? How many amount of stocks in their portfolio? How to even monitor? How do you even do proper research on so many stocks? Why don't you just buy a fund instead? Yeah. So if your portfolio too complicated and you don't even know how these stocks interact with each other, right? Like, is it inverse stock or like they are related stocks or complementary stocks, you don't even know, then you just dump them all into your portfolio. So it's too complicated for you to manage. And also you need to like do your day job. Do you really have time to manage such a complicated portfolio? Okay. And most people trade based on emotions, and then they have unrealistic expectations. Like they expect to like double their money in one day, that kind. Yeah, so trading based on emotions is instead of like, because when you trade, you should be based on like technicals or fundamentals ma. Okay, trading should be more about technicals lah. Yeah, but if you are investing, it should be more about fundamentals lah. So if you trade based on emotions, then you definitely will end up bad lah, unless you are very lucky. Yeah, so supposed to be buying high and buying low and selling high lah. But then most people do the opposite instead. So like they see like the stock market keep going up, right? Then they feel FOMO, then they want to buy. Whereas when the market crash, right, nobody wants to even buy. Yeah, so they actually do the opposite of buy low, sell high lah. Yeah. Then another one that most people do and really make them lose money is leveraging when they are unskilled in trading. So like, yeah, you know how leveraging works, right? So basically, if you got 10k, you can use 100. You can buy stocks up to maybe 100k. So leveraging of like 10 times lah. Yeah. So when you leverage, definitely your losses will be amplified and your gains will be amplified also. So when the losses are amplified means you can lose that whole 1k lah. I mean 10k, then I say 10k, right? Yeah, you can lose that whole 10k easily when there's a margin call and stuff. Yeah. So if you are not good at trading, please do not do leveraging, because you can lose the whole sum of money in a quick time. Yeah. Okay, and other reasons is not having goals of what like this stock, how much they want to achieve, and then how long are they going to hold it for. They just buy and sell based on their emotions. So you need to have goals like both short term and long term. Just like randomly investing is not going to work out. Yeah. Okay. Another one is a lot of people like to go like all in into one stock, like Baba. Oh, let me throw all my money into Alibaba. So putting all eggs into one basket. So imagine if I put all eggs into one basket and I invested in Baba earlier this year at like $300. Invest all my money, okay? Then now what's the price? Price is like 120, right? So I already lose more than 50% of my money. Am I still going to continue? Can I really still afford to continue to hold? Yeah, so it's really not wise to put all eggs in one basket. But if you're already investing in one fund, right, it's not really putting all eggs in one basket because it's already a diversified kind of portfolio already. Yeah. Okay, so yeah, these are all the reasons why people lose money in the stock market. I believe most of you all fall into some of these categories. If you're an expert, then definitely you can do it yourself. But most people really think that they are the expert, but they are not. Yeah. Okay, so some facts on short-term versus long-term investing. So for short-term investing, right, if you see like 380 is the starting price for 6 months, then you can see the 52-week low actually go below 380. And 52-week high is also can go upwards, downwards a lot of percent . But whereas you look at like long-term investing, right, you can see like for 10 years ago, so this like I think 2010, so like 11 years ago it started at like $100, and then when you look at like 10 years later, 2021, right, you can see that the price never ever dropped below $100. So it's unlikely in long-term investing that you will ever make losses . Let's say we just look at 200, it dropped 200, right? So if 100 to 200 over like 10 years, it's still like maybe 5% a year. It's still not making losses. So for people who are scared of investing and really want to try, you really should try because investing in funds is unlikely to make you lose money over the long term. Because how all these fund works, right, is like it follows the market. So everyone knows that market keep going up, right? Unless it's really like the whole market crash, then that one is everybody wipe out together with you. So why not let everyone wipe out together with you So it's quite unlikely that will happen also. Yeah. Okay, so people also talk about investing afraid of entering the market at the wrong time. So what can help this is a dollar cost average. So how it works here is like you just put in money at every certain like interval, like maybe you want to do monthly, so you like every 15th of the month you will throw in your money into this like fund. So this is called dollar cost averaging. So it can help take the emotion out of investing. So you do the dollar cost averaging, right? Don't keep looking at it Keep looking at it, you will feel like taking it out, Yeah. So anyway, like I mentioned, dollar cost averaging compels you to continue investing the same or roughly the same amount regardless of market fluctuations. So help you avoid the temptation to time the market because like I mentioned, a lot of people think they are pros at timing the market, but actually they are not. Okay. So this is help to lower your risk okay, instead of doing a lump sum investment. Okay, so what are the best tools for this dollar cost averaging. You can do it yourself using ETFs, means every time you just put in a whole lump sum of money, but then you dollar cost average but yourself, like every 15 you go and enter this ETF. Okay, and others, if you want to do it like more easily, right, is can rely on like robo advisors or investment link plans. Yeah, so this one will directly like it will just deduct from your bank or whatever directly, so you don't need to do anything. Then you don't even need to be remembered, hey, today is 15, I need to go and throw my money into the fund. Yeah, so these are the best tools to help you manage your money instead of you going to manage it yourself. If you have the time to do it yourself, yeah, ETFs is the way to go. Okay, so in case you don't have any financial knowledge, let me share with you how compounding interest works. Okay, so compound interest, right, if you save $100, right, at 6%, for the first year you give you $6. For the second year, you never put in any new money, right, it will give you $6.36. So this amount that they give you every year will keep growing every year. Okay, so based on this theory of compounding interest, right, you will take 72 years to double your money if you save at 1%, whereas if you save at 10%, right, you only need 7.2 years to double your money. But as humans, how many 72 years we have? We cannot be saving at 1%, right? At young age especially. Yeah, so we need to think of ways to try to grow our money at higher interest rates. Yep. Okay, so I'd like to share this example of two people. So one guy, he starts investing, one guy B starts investing at 19 years old. He invests 2,000 per year from the age of 19 to 25, and then he stops thereafter. So total he put in like 14k into the stock market. Whereas A starts investing at 38 years old. Then from the age of 38 to 65, right, he invests 2k annually into the stock. Okay, then total he invests 56k, which is 4 times more than B. Okay, so assuming they both generate 10% yearly, who do you think has more money at 65 years old? So most people see like A invest more money, definitely he will have more money at 65, but it doesn't make sense for the other one to have more money at 65, right? But nope, that's not the answer. The answer is actually B will have more money than A at 65 years old. In fact, if you times it, right, it's actually 4 times more than A. B invests so much lesser, whereas he gets so much more. Why is this so? It's because of how compounding interest works. Because if you see this slope, right, of B, he started very slowly. It's a very gentle slope at first. Then slowly the curve, right, becomes very exponential. It starts to become very steep. Okay, so that's how his money grew. Whereas you look at B, right, because he started at 38 years old, he haven't even reached the steep part, so he is unable to catch up with investor B. Yeah, so that's the reason why you should always start investing and saving early. Because if you do it too late, right, you will never reach the steep part of the curve. Yeah, so even if you are very old now, just start investing already. Because any delay, you will never reach the part of the curve. Yeah. Okay, so also sharing on the types of insurance products and how many types of insurance products are out there. Okay, so we'll start from the basic, which is the term insurance. So term insurance is the cheapest form of insurance. So depending on your target age that you want to cover until, right, then they will determine the premium amount. So it's pay as you use. So if pay as you use, so the coverage stops once you terminate. Terminate means you stop paying the premium, then the coverage stops. So even if the insured events does not happen during the term, right, you will not get anything back, but you will get to enjoy the peace of mind during the coverage when you are getting the coverage when you need it. Yeah. So usually for this kind of term plans, right, you can renew it, but it's usually for the same amount of term but at a step up premium rate. So what it means is if you buy for like a 10 years term plan, you can renew for another 10 years. But whatever you pay for the 10 years term plan, right, maybe you pay 500, right? Then now you want to renew another 10 years, right? Maybe you need to pay $2,000 per year instead of $500 per year. So that's what it means by can renew, but that it will be at a step up rate. Yeah. So usually you also can convert your term plan into a whole life plan, but this will be more expensive than when you buy a new plan. So if you are in good health after you finish your term plan, right, you can continue to buy a new plan, because that will be cheaper than you renewing your plan. Yeah. But if you are not in good health, then you have no choice that you need to renew it at a step up rate. Yeah. Okay, so another type is a life or endowment plan. So how they work is in a similar way lah. Yeah, they basically have a guaranteed and non-guaranteed amount. Oh, so just now I didn't mention, right? Term has no cash value lah. So life and endowment plans always have cash value. So they will have a guaranteed and non-guaranteed amount. Okay, so for the guaranteed amount usually is a very basic amount. Then the non-guaranteed amount is dependent on a par fund performance lah. So if you stop paying the premium, so let's say your premium term is 15 years, but you stop paying on the 10 year, right, you will still continue to enjoy the coverage, because usually there's a cash value on the plan and it will be converted to an automatic premium loan. So the loan is like used to pay for your premiums, but you will still have the coverage. So if let's say you buy a 100k sum assured, then you stop paying on the 10 year, then maybe until the 15 year, then you actually get like CI lah. For example, you get CI and then they pay out the 100k, but the 100k won't be wholly pay out, because there's, like I mentioned, there's an automatic premium loan, right? So depending on how much the premium loan is, so you need to 100k minus your premium loan, then that's the amount they will pay out to you lah. So it means that you will still enjoy the coverage even though you didn't do the full premium payment. Yep. But it's like lesser coverage lah, because you didn't pay the full premium. Yeah. So what's the difference between life and endowment plans? Okay, so life plans usually cover death, total permanent disability, and critical illness, whereas endowment plans, it covers usually only death. Yeah. Okay, so life plans usually cover until 100 years old at least, or life for whole lifetime lah. So lifetime means if you live to 125, they still cover you. So until you really pass away, then they stop covering you lah. Okay. Then for endowment plan, it covers, depends lah, whether you buy 10 year, 122 year, or whatever lah. So very flexible usually for endowment plans, because it's not really for coverage, it's more for growing your money at a safe with guarantees, like growing your money with guarantees. Yeah. So premium paying period for life plans usually is a limited pay, so maybe 10-20 years like that. Endowment plan can be limited pay or as per policy term lah, so depending on how the plan is structured. Yeah. Okay, so what I mean by just now dependent on par fund performance, right? So usually at the top of your policy illustration for a life or endowment plan, you will get to see this performance of par fund. So if the performance of par fund has been usually like maybe 5 or 6%, right, then usually you can get a projected investment return of the right side column lah. Usually you see your policy illustration, there's a lot of tables, right? Yeah, then the tables will have projected at 3.25 or projected at 4.75. So what does all this means, right? It means it refers to the performance of par fund. So if the par fund is constantly performing at 3.25%, right, then you will be getting these returns. Whereas if the par fund is constantly outperforming this 4.75, right, you can get these returns or even more lah. Yeah, so need to check the past performance of your par fund. So if it has been good all along, then usually in future will be good lah. But as you know, past performance is not reflective totally of what happens in future lah. So take it with a pinch of salt also. Yeah. Okay, so lastly there is investment linked plans. So investment linked plans are how it works, right? Is the premiums are first used to pay for the insurance coverage. Then the remaining after the allocation to the insurance, right, is used to buy into units of funds. Yeah. So after a certain number of years of paying premiums, right, usually you can go on premium holidays if your investment value is enough to support the portion to pay for the insurance premiums. Yep. Okay. So what are the charges for investment linked plans? Usually fund management charge, administration charge, surrender charge, bid offer spread. So most of the plans around don't really have bid offer spread anymore. So if you want to do fund switch, it's usually free lah. Yeah, so fund switch charge. Oh, so fund switch charge and bid offer spread is actually different lah. So fund switch, sometimes they will charge you just for changing a fund, whereas the bid offer spread is the buy and sell price. There's a spread that usually insurers can earn from you, but they usually waive it already. So all these two usually waive already. So what I need to be aware of is usually surrender charge, admin charge, and fund charge. Yeah. Okay, so this is the summary of the 3 products that I talked about. So term, life, or endowment versus investment link. So basically, most insurance products either fall under these 3. So you talk about like hospital insurance, what does it fall under? It's fall under term, okay? So if you talk about accident plan, what does it fall under? It fall under term also, okay? If you buy like any investment link product, I mean, quite sure you know what is investment link product, yeah. So then you buy for life, then it's life plan lah. Then you buy a savings plan, it's an endowment. Okay, so most plans fall under these 3 categories and nothing more. Yep. Okay, so I mentioned term plan coverage until specified age, renewable and convertible. Premium payment is every year. No cash value, no bonus lah. So it's something like renting a house. Okay, so you pay for what you need. Okay, life and endowment plan cover until, like mentioned, for a lifetime, limited pay. Then there will be cash value that is guaranteed and also has a bonus depending on the par fund growth. Yeah, so this is like owning a house. Okay, so for investment link product, also can cover until 100 years old or lifetime lah. So depends. Okay, can be flexible based on the premium payment length, right, is flexible depending on how your investment goes. Whether cash value or bonuses, yes, based on investment growth. So this is like owning something and investing. Yeah. Okay, so moving on to the types of insurance benefits. Usually, what are the benefits that they confer onto you is only 3 types. Either it's a reimbursement. If it's reimbursement, it means like it's a very basic coverage, just a reimbursement of what you have actually incurred before, like hospital bills. Yeah, what I incurred, they reimburse me. Okay. Another type is lump sum payout. Okay, so lump sum payout are those like critical illness, death, and total permanent disability. So they pay out the whole lump sum of sum assured once something is confirmed to have happened, like death confirmed to have happened and CI confirmed to have occurred lah. Yeah. Okay. Then another type is either annuity or monthly payouts. So annuity is usually for retirement plans. They will pay out monthly. And then other kind of plans are usually the disability plans that they will pay out monthly instead of lump sum payout. Why they do monthly is because in the event that your disability recovers, right, they will stop paying you. That's why monthly payouts. Yeah. Okay, so I finished this part in what should be in your financial portfolio. So like I mentioned there should be a mix of insurance, investments, cash, and your property lah. So I've covered most of them except property. Property, I'm not 100% qualified to talk about it, so I will not be talking about it. You can read about it somewhere else. But if you want, I'll be sharing shortly on BTOs lah, because I have personally gone through BTO, so I decided to share more about it as well. Yep. Okay, I've come to the end of my sharing. Hope you have learned something new. Yeah, and hope you have learned something new about how to plan your whole financial life, financial portfolio, everything lah. Yeah, so if any questions, feel free to reach out to me. Okay, so thank you everyone for watching this video. If this video has helped you, please remember to like and subscribe. Thank you everyone. Bye bye.